For more on the latest moves as stocks close the day in the red, let's welcome in now Ryan Detrick, Carson Group Chief Market Strategist. Ryan, always great to see you, my friend, on the show. Ryan, look at this market. We got spooky headlines, got drama, got volatility, I've got politics. You do take a deep breath here, Ryan, and you remind us that, it is not that unusual, actually, to see a week late February, and even the first half of March can often be tricky, correct?
Well, that's right. Thanks for having me back, guys. I appreciate it. Happy March Madness, everybody. It is madness out there. Yes, you don't blindly ever invest in seasonality. I want to be very clear there. At the same time, we know historically the second half of February is usually pretty weak. The first part of March is usually pretty weak. The first quarter of a post-election year, where we are right now, is usually pretty weak. After a 20% gain, the first quarter is usually pretty weak. So to see after the 70% rally we had back-to-back 20% years, to see some consolidation and sideways action here, choppy, frustrating action, scary in some ways, not surprising. One more quick comment on this. It's not the whole world selling off. I know you've got a lot of good guests who have been pointing this out. Most of the world is up this year except for the U.S. and India. U.S. and India led the most the last 2 years. The baton is being passed around. Yes, we think the U.S. is going to play catch up here, and we're by no means bearish. But to see this kind of pause in the first quarter here, Josh, is kind of normal, to be honest.
And so, Ryan, what about what happens after the kind of pullback that we have had, right? Because we had our correction in the S&P. I know you've been looking at the numbers through that lens also to see what happens after.
Well, I guess, how do we want to put this? Let's hope it goes up after, right? Now, piece it up. Listen, great question there. I think what's fascinating to me and to a lot of people about this, we had the 10% correction. Of course, it was more like Jared just talked about, right? Tech has been lagging, Mag 7 been down more. But the sentiment we are seeing on what I'm going to call, again, a normal 10% correction, which you tend to see a lot of years, is incredible. Just today, that AAII sentiment poll, and I get it, there are flaws with this potentially. Just know, 5 weeks in a row now, a record, like 5 weeks in a row, we've had more than 50% bears. Only 2 other times we've seen that. October of 1990 and then October of 2022. For those with history books, that was the end of vicious bear markets back then. And then the market did well. So that's just one sample size. I get it. But the over-the-top negativity we're seeing is something that's fascinating. I mean, just think about it like this. Markets change, yes. There's different computers and different things. What never changes is our emotions, right? People get too bullish at the peak and too bearish at the bottom. That's never going to change. I'll tell you, Julie, we are seeing over-the-top negativity to us, which suggests maybe we just had another mid-March low. The last 20 years, last thing on this, last 20 years, the market bottoms on March 12th and then rallies. We just bottomed on March 13th. I don't know if it's that simple, but I think we might have hit another March low here.
So bottom line, Ryan, what are you all doing now in your portfolios that you run for advisors?
Yeah, not panicking, I guess, for starters, because we expected some volatility. We say, stay diversified, right? I've come on with you guys for a while saying we think the U.S. is going to do well, stay in stocks. Yes, but what we've started to do a little bit, we're looking around the world. We look at Europe that potentially could do better. Emerging markets, maybe not quite as much there, but we look at things like gold. We've had gold in our tactical models for gee whiz, almost going on 2 years now. I think gold, hit a new all-time high again today. So stay diversified. We have an overweight to equities, yes. Do we still like the U.S.? Absolutely still like the U.S. I mean, to us, like the conversation before I joined, we're more neutral tech, right? We think maybe you still see a little bit of lagging out of tech. And there's other areas. I mean, let's look like low volatility, right? Low volatility is pretty much everything except for communication services and tech. Low vol's up pretty good this year. Financials, industrials, there are some groups, like 9 out of 11 groups are up on the year. So it's not like the market's down and getting killed. I know it feels like it because everybody's in Mag 7, but stay diversified and just continue to enjoy what we think is still a bull market.
Ryan, I'm going to take the other side of this for a minute. What if we're in a scenario where the markets haven't actually priced in a bad enough scenario? Like, you're not the only guy coming in here to say, I still like the U.S., I still like big tech. I mean, if these tariffs go into effect and they stay in effect, if the tariffs next week, that we don't know exactly what they're going to be, go into effect and stay in effect, right? Like, if you see the IRS, which just fired however many thousand people, doesn't collect that many millions and billions of dollars of tax revenue. There are some things here that could turn out not so great. Has the market priced those in?
Well, I'll put it this way, great question there. One I think we're all trying to figure out here. When I look at the over-the-top negativity, I think a lot of that has been priced in, right? When President Trump won, what did we expect? We thought, well, maybe extension of the tax cuts from 2017, some deregulation, and tariffs, right? Now, it hasn't happened in that order, and that's what's kind of upset. We're moving forward with potentially extending the tax cuts from 2017, which could be a positive thing. But you're right, there is a lot of uncertainty out there. There's usually uncertainty. But again, what helps us sleep at night is being diversified. Yes, the U.S. hadn't done as well. But again, other parts of the world really have. And honestly, we didn't like treasuries for 2 years. We started dipping our toe in some treasuries because, again, we think, diversify your diversifiers. If we get a pullback in the market, bonds might do okay. And I know people were burned by 2022 because that was not the case at all. But look at this recent, 10% correction we had. Bonds did pretty darn well. So just have some bonds, maybe have a little gold, some commodities, and still stocks, and it'll hopefully weather the storm from volatility that we might see, or we will see probably, honestly, around these tariffs. But once we get to the other side, we still don't see an economy with a recession. Just look at today, right? Initial claims still solid. No durable goods yesterday. You can pick and find problems with it. People are still buying stuff. People still are not getting laid off yet, and maybe it changes. But for now, this economy is still okay in our view.
Right, I was just looking at how we ended the day today, and there was some red on the screen, but I was, maybe some people were actually surprised, we didn't see harder selling today. And I was going back and forth over email with Steve Sosnick, another smart market guru like yourself, and I was asking him what he kind of made of that. And he said, in a perverse way, he told me, maybe we actually got some clarity today, maybe not full clarity regarding tariffs, but some clarity. Maybe that explains it. What do you make of the market actually we saw today?
Well, that's right. I mean, listen, put it this way. Yesterday, right, the S&P dropped over 1%, yet more than half the components of the S&P 500 were higher yesterday. I haven't had a real good chance to dive in today, but again, that tells us there's a lot of stocks, just equal weight, right? There are a lot of stocks that are still hanging in there, and it is tech, like you guys talked about with Jared before I came on, that really kind of is masking or causing, I guess we could say, a lot of this underperformance, and that's why, again, you probably don't want to be wildly overweight tech, wildly overweight the Mag 7. There's other areas that are doing pretty well, but I agree with Steve there. But it's impressive to me. Listen, right as of this second, I think, well, put it this way, as of yesterday, I'm not sure about today's data, 9 of 11 sectors were up on the year. Okay, we just gained 20% 2 years in a row with stocks, and 9 of 11 sectors are higher on the year as of yesterday. So I don't think that's the end of the world when you think of it like that.
I guess you're right. I'm just looking at the data. 9 of 11. We've got, 8 of 11 are higher on the year.
8 of 11,
so
okay.
So still, not too bad. All right, Ryan, great to see you. Thanks for being here.